On June 9, 2015, a single J.Crew storefront on Fifth Avenue lit up its marquee with a $50 million luxury campaign, signaling the brand's boldest bet yet and, unbeknownst to shoppers, the beginning of the end. It was the same year that the pre-PPY staple, once the uniform of Ivy League campuses and suburban brunches, announced a new era of premium fabrics, higher price tags, and a runway-ready aesthetic that seemed destined to catapult the company into the rarefied ranks of luxury retailers. But behind the glossy ads and runway shows, a tangled web of debt, aggressive expansion, and a shifting cultural landscape were quietly pulling the rug out from under the brand that had dressed America for 3 generations. Founded in 1983 by the visionary duo of Tom and Emily Frey, J.Crew began as a modest, family-run shop in New York's Soho district. Its early success hinged on a simple formula: classic American style, impeccable quality, and an approachable price point that let college students and middle-class families alike buy a piece of timeless design. By the late 1990s, the label had become a cultural touchstone, its navy blazers and crisp button-downs appearing on the backs of presidents, movie stars, and everyday commuters. The brand's ascent was meteoric. Revenue grew from $100 million in 1995 to $2.3 billion by 2010, and the company expanded internationally, opening flagship stores in London, Tokyo, and Seoul. Investors flocked and J.Crew's stock surged, rewarding shareholders with double-digit returns year after year. Yet even as the numbers looked golden, warning signs flickered beneath the surface. In 2005, J.Crew embarked on an aggressive acquisition spree, purchasing the high-end label Madewell and the menswear specialist J.Crew factory. The deals were financed largely through high-interest loans and a revolving line of credit that would later swell to over $1 billion. Executives justified the debt by pointing to the brand's premiumization strategy, higher margins on upscale collections, a shift from mass-market basics to luxury-inspired pieces. The move attracted a new, affluent customer base, but it also alienated the core shoppers who had once made J.Crew their go-to for affordable style. The brand's financial architecture grew increasingly fragile. By 2011, J.Crew's balance sheet was burdened with $1.2 billion in long-term debt, and the company was paying an average interest rate of 9%, unusually high for a retailer of its size. Cash flow began to tighten, and the firm started to rely heavily on seasonal sales spikes, especially the holiday rush, to service its obligations. Meanwhile, the fashion landscape was undergoing a seismic shift. Fast fashion giants like Zara and H&M flooded the market with trendy, low-cost alternatives, while digitally native brands such as Everlane and Bonobos capitalized on e-commerce and transparent pricing models. J.Crew, anchored to its brick-and-mortar heritage and slow-moving inventory cycles, struggled to keep pace. The first cracks became public in early 2014, when analysts flagged a 12% decline in same-store sales for the fourth consecutive quarter. The company responded by slashing advertising budgets, closing underperforming stores, and launching a costly refresh initiative that promised modern designs with classic DNA. Yet the initiative required substantial upfront investment in new fabrics, redesigns, and a global marketing push, expenditures that deepened the debt pile rather than alleviating it. In March 2015, J.Crew announced a $500 million debt restructuring, swapping high-interest notes for longer-term, lower-rate bonds, a move that temporarily steadied the stock but left the company vulnerable to any downturn in consumer confidence. The true tipping point arrived with the COVID-19 pandemic. In March 2020, as lockdowns shuttered storefronts worldwide, J.Crew's already fragile cash reserves evaporated. Online sales, while growing, could not offset the loss of foot traffic, and the company faced a looming debt covenant that required $150 million in cash within 90 days. On May 4, 2020, the board filed for Chapter 11 bankruptcy protection, revealing that the retailer owed $1.4 billion to lenders, landlords, and suppliers. The filing listed 70% of its 500 store locations as unprofitable, and the once iconic brand that had defined the American wardrobe was now a cautionary tale of over-leverage and missed adaptation. The collapse sent shockwaves through the industry. Employees were laid off en masse, with more than 5,000 workers losing their jobs overnight. Suppliers, many of whom had extended credit in good faith, were left with unpaid invoices, prompting lawsuits that further tarnished the brand's reputation. Investors who had once hailed J.Crew as a blue-chip growth story saw their holdings wiped out, and the stock, which had peaked at $58 per share in 2011, closed at pennies on the dollar after the restructuring plan was approved. In the aftermath, a consortium led by the private equity firm Simon Property Group and the retailer's former CEO Michael Murray acquired J.Crew's core assets for $400 million, a fraction of its former market value. The new owners stripped away the debt, closed an additional 150 stores, and pivoted the brand back to its original DNA, affordable, classic American basics. Madewell, which had been spun off prior to the bankruptcy, continued to thrive independently, while J.Crew's remaining stores adopted a leaner footprint and an aggressive digital-first strategy. By 2023, the brand reported modest profitability, but its footprint was a shadow of its former self, and the era of J.Crew as a cultural arbiter was effectively over. The story of J.Crew serves as a stark reminder that even the most beloved institutions can crumble when growth outpaces sustainability. Subscribe to The Collapse for more stories like this.